the first important aspect of trend trading, it is one, the ability to spot trends, and it looked like a very, very easy thing, but a lot of traders, they really struggle to spot market direction. Why? Because firstly, they don't know where to look. Secondly, if they don't know where to look, it will happen that either they look at one place or they look at very a lot of different places. When I'm talking about places, I'm referring to time frames. A lot of traders, they will look at one time frame and say, I can see USD JPY in a 4-hour, it is moving in an uptrend, only to find that this uptrend in the 4-hour, it is just a corrective wave in a downtrend. Let's say in the daily the market is moving down, so now it's in a corrective, so you will see this corrective as a trend, and you will lose your money, because this in a higher time frame, it is a corrective, but you, because you are looking at the market in one eye and you're looking in a bit smaller time frame, then you're going to think this is an uptrend, yet it's just a corrective. The market is going to impulse again, and that's why a lot of traders, they raise questions like, when I enter the market as a buy, the market always goes against me. That's a common thing among traders. Good, so recording going be on your YouTube channel. Yeah, it's gonna be on my YouTube channel, but that's not a permission for you to leave this meeting. So yeah, it's gonna be on my channel. I'm gonna post it on my YouTube channel, and also I'm starting a podcast. Yeah, a podcast soon. So I'll also be accepting questions from you guys. So yeah, but I'm gonna post all the details on how to send maybe a voice note of a question, then I'll be answering it in the podcast, or even invite you to be there. So I'm gonna share it on the Telegram. Yeah, it's gonna be for everyone. Yeah. So what you need to know is that you have to know where to look at the market direction. That's why we've been introduced to multiple time frame analysis. That's why we've been introduced to that, so that it will save us to be able to see the market in a very, very good picture. So make sure that when you are trading in every time frame that you use, this is the first important rule of trend trading. Make sure that you look at the bigger time frame as well. When I am looking at this 4-hour, where is my cursor? When I'm looking at this 4-hour, it is necessary for me to also go and look in the daily. For an example, you can see in the daily that the market is telling me a different thing. The market is telling me that I was flowing down, but now I'm kind of shifting into an uptrend. And the way the waves are structured in the time frame, it is different. It is different, because we can see that where is my drawing? We can see that here we have a very, very big move in the higher time frame. It kind of look like just an entire wave. So it is likely that the market might correct in some time, and the corrective might be a bit bigger, something like this, and it goes up again and again. But this in the lower time frame or in the hourly will look like a downtrend, just as this is now looking like an uptrend. You see, just as it is looking like an uptrend, as you can see. So that's the importance of time frames, considering a bigger time frame, because that's where the big guys are. That's where the market flows, in the trend of a bigger time frame. Actually, it doesn't mean that you should look at the daily, then go to the yearly, then go to the decade time frame. No, just look at the time frame above the time frame that you use to trade. Just look at the time frame above that. So that's the first important thing. Then next, what you need to consider when it comes to trends or trend trading is that the trends are also made by ranges in a bigger time frame. Trends are made by ranges in a bigger time frame. Let's say we have a resistance, we have a support, and then let's say we have price, with price moving up, price moving down, and price moving up, and price moving down. So this range in the higher time frame, this range in the hard time frame, let's say this is a range which is on the daily. This range in a hard time frame in the daily will portray or will reveal trends in time frames like the 1 hour time frame. It will portray and reveal trend. In the 1 hour, you will not see this as a downtrend, as a downward wave, but you will see this as a downtrend. And you will not see this as an upward wave, but you will see this as an uptrend, which is a kind of long term to you. So this is a key thing that you need to know, that trends are made by ranges. So when you see a trend, it might mean that that trend is coming from a range which is on the higher time frame. So trends, they are made from ranges. So what does that mean? What does this has to do with your trading? So remember, guys, the way we analyze the market, it is that the first important thing, it is looking at the hard time frame and considering what? Key levels. Those who've been following us for a while, they know it's key levels which matter. Why are the key levels matters? Just the explanation that I made, that the reason we study key levels, it is because I will kill someone. Let no one drain my screen. Don't drain my screen. So the importance of key levels, it is this that I'm explaining now, that so that you will know when that trend is going to end in your trading time frame, or in your in that time frame that you are using, that it reveals when will the time frame end. So let us figure out an example here. Let me just clear the drawings and see what we got. Let us just look at the hard time frame. So guys, every knowledge or every theory that you possess as a trader, it should be explained. There should be an explanation to it. There should be a clear explanation on why is something like that happening. I just need a daily trend, a daily range here. I seem not to find it. Okay, maybe we'll try that one, but let me see. Every idea that you have as a trader, whether it's an idea that you learn that the market is going to be making the market usually reverses in head and shoulders, you have to give me an explanation, give me a reason of that notion of a head and shoulders. How is it happening? Why is it happening like that? So let's make an example of this market here. We can see that it has been bouncing in one level for this case, which is this resistance. Let us not consider much of structures below, but let's just consider this one low here. So let's say it was bouncing between these two. So you look at how the structure is here, and then we'll go maybe in a lower time frame like the 30-minute. There we go. So do you see in the 30-minute that now it looks like just this overall move, it's just a downtrend at its own. So you can see how it is moving. So you can be tempted and say, wow, the market is moving in a downtrend, so we are ready to be putting the sells. Let us prepare for selling long term, and only to find that here the price is close to a support and it is going to bounce and continue its range or continue its funny move, which you don't know. So that's the importance of these guys. Make sure that you study the key level. So I'm just let me let these guys in. Wow, it's a lot of them. I'm just trying to explain the theories or the things that have been given to you guys, those key levels, market direction. Why are they necessary? So in trend trading, it is not just focusing on the trend, but the range in the hard time frame is what makes the trend. It is what forms the trend. The trend is there because there is some kind of supply and demand happening in a hard time frame. So I hope that one is making sense. I hope it is clear. I hope it is clear. So everything that you have, every theory that you have, it should be explained. It should be backed by an explanation. What am I doing? That's what matters. You will just have a clear understanding of everything. Form that explanation behind patterns, because now we trade forex like mathematics. Now the way we trade them is trade. Some trader will tell you that market is going to do this and then form a flag and then form a breakout. But can you explain me in financial ways and in market psychology, why is this happening? Can you explain? If you can't explain, it means that you don't know what you are doing, and if you don't know what you are doing, it means that it will be hard for you to make money. You'll be more like a gambler. I hope that one is making sense. So where is the trend that I was opening, so that we can continue to the next key point? So let's use this market here. So when it comes to trend trading, once you are able to spot the direction, it's simple to spot the direction. It's either you use the 200 moving average. For an example, this moving average here, when price is above the moving average, it's an uptrend. No questions asked. No, you can't hear. Or if you can't hear, it's simple. You have to check your settings. Let me just write to them. So it's guys, it's either you use the moving average, or it's either you use your eyes. When you use your eyes, it's simple. You just spot highs and lows. So the highs should be higher and the lows should be higher as well. So higher highs and lows, they should be higher as well. So the market should be forming that structure. Once that structure is disobeyed, it's no longer an uptrend. So I think spotting trends is just the beginning of trading. So if you can't spot trends, then you are not ready to start trading. There is a good book in trend trading which I read when I started. I can still remember it. I think it's Trendentia. Yeah, Trendentia. I think it's, yeah, it sounds like that. I can still remember even how it appears. So once you spot the trends, it is how you enter them. How you enter them, there are just a few ways on how to enter market trends. There are just few ways that you can use in entering market trends. For an example, there is the one famous method which is retest. By focusing on retest, that's one method, meaning a retest of the horizontal levels which are on the market trend, not the hard time frame. The levels on the hard time frame are there to portray market reversals, but key levels on your trend are there to give you entries, or where market is likely to reverse or retrace. So for an example, this resistance here, it is likely to give you the next entry or the next support. So that's the first method, by spotting horizontal levels and then entering the market there. For an example, we had this as a resistance, but then later it became support, so which was an entry point for you as a trader. And then we have this resistance which is likely going to be support now, and which will be an entry for you as a trader, following the entry method that I always teach, which is pattern breaks and everything. So now that's the first method. Now, observing the previous high into becoming the next low or the current low. Same thing applies in a downtrend. It should be the support becoming resistance, and you are entering your trades there. That's the first method, and this is a bit significant. This method, it is one of the best methods, and it is proven to be accurate even compared to entering using the trend, even entering using a trend. So I'm just going to explain the three methods. This is the first one, and then when it comes to the trend one, it is that one which you guys love. For an example, drawing a trend line, it is that one which you love, and it is one of the dangerous, although it seems not dangerous in your eyes, but it is one of the dangerous markets, because usually what you guys do, which is very wrong, it is what I call line analysis. You just tell your friend that I have drawn my trend line, my price is going to bounce here and go up, and it is not a good approach. Price doesn't obey lines. It obeys market psychology, because it is moved by market psychology. So it's not a matter of lines. That's the worst thing that you guys do. It is drawing lines and say price is going to bounce in your lines. Instead of saying that, the thing that you should say is saying, okay, I've drawn my trend line here. What you should say is that your trend line should be there to show you the slope of the market, or the flow of the market. How is the market flowing? Is it flowing aggressively? Is it flowing just in a good way? Is it flowing very, very slow? So remember the different types of market strength. That is it very strong? Is it just good? Or is it weak? So you should use the lines in that way. And also saying this is not just a line, it should be something like a zone. It should be something like a zone. So around this line, prices is likely to bounce and go up. So not exactly in the line. And as well, the other issue of saying, where should I draw my trend line? Is it in a body or is it in a tail? What I usually say is that, okay, it's the body, because the body, it resembles the close, meaning the end of the body, the close of the candle, not the tail, because the tail resembles the rejection. But now here is another truth. It is that we should make sure that we don't strive for accuracy in drawing trend lines. We don't strive for accuracy in drawing trend line. For an example, one can connect, maybe let me connect just these lows. One can connect these lows like this. Maybe let's say he's connecting the tails. Where is this thing? He will connect his lows like this, and all of a sudden, when the market comes here, do you see that the market bounces, but it doesn't touch the line exactly? The market doesn't touch the line exactly, and a retail trader will usually miss this entry. Why? Because he is focusing on price touching lines. He's focusing on price touching lines, not actually that line resembling a zone or a likely area where price is going to act. So it's either you enter by the first method and by or by a trend line. The best way it is to apply all the method that I'm going to teach you, but the trend line, make sure that you don't do what I'm just talking about, doing line analysis. No, price doesn't obey lines, it obeys psychology. So your lines should there to indicate or to communicate to you that it is likely that price is going to bounce around this line or near or close to this line, not actually in the line. Price can breach the line and go down and then come back in. Price can bounce before the line and go up. So that's why a lot of traders suffer from fake breakouts, because immediately when price bridges the line, they say, no, it's a sell, it's a breakout. It's a breakout, and they put those cells, they put the cells, and all of a sudden market corrects and comes back in. Why? Because they observe lines. I hope it is making sense. And I hope it is helping. So now here is the other method which I once taught some time ago. Yeah, it's the strategy, guys, which a lot of investors use. It's called value investing. It's called value investing. So it was I think it was formed by Graham, who taught Warren Buffett. Yeah, it's his method of investing, value investing, whereby we use the line of intrinsic value. So that's something which is very, very important. This is just a breakout or a breakthrough. What am I saying? Breakout. It is a breakthrough when it comes to trend trading, value investing. So value investing, it is actually, I think we learned this in mathematics, but I forgot the name. Those who love mathematics, they know this thing. So value investing, it is actually drawing a line of intrinsic value, not in the bottoms or in the highs, but between the trend or inside the trend. For an example like this. So this is just to show you or to highlight to you when price is high and when price is low, because when you draw it in the middle, you need to know that price fluctuate around this line. This line should be like an anchor of the price, where price move around. It is rotating. Yeah, it is rotating around this line. This is the center of the price, meaning it is going to go up and go down. It is going to go up again in between this line. So this is the line of intrinsic value. So what you do as a trader, it is observing where price is. If price is above this line, it means that you should be looking for selling opportunities. You should be looking for selling opportunities. If price is below, you should be looking for buying opportunities. And to take this method further, I think I'm also going to make a video soon explaining further about this method. Junior Mott is raising a hand. I don't know what's the problem. You can type the problem in the chat box. So what happens that when price is above the line of intrinsic value, you should be looking for selling opportunity, and it should be selling opportunity one when price is now flowing down, ne? But not below the line. It's above the line and now it's beginning to move down. For an example, here it's above the line and it's now beginning to move down, so you should make sure that your price is beginning to move down, ne? Then you can press your sales. And the most important thing, it is to make sure that if there is a structure, there is then a breakout of that structure. For an example here, there is then a breakout of that market structure. It's like a lot of things have changed in trading view. They've updated a lot of stuff. So here you should be making sure that the flow of the structure above the line of intrinsic value is broken if there is a structure, and if there is a flow. For an example, in this case, there's just a series of green candles going up, so it's a market flow, and you should make sure that that market flow is as well broken. For an example, up there, ne? It is as well broken, so now price is facing down. Same thing applies in the buy side. When you want to buy, we should make sure that price is below the line of intrinsic value and price is facing up. If there is market flow, make sure that that market flow is now broken, and that market structure is now broken. For an example, this corrective manner here, it is now broken, ne? So I hope it is making sense. So this is the third method, guys, which is very, very effective. It is very, very effective. Trust me, this is the way out in long-term investing, or even short-term. It's just the way out, because here you are not bound by drawing trend lines. You are also not bound by resistance and support. So you just use the mean price in that particular trend, or the intrinsic value. So you use it. For an example, now price is below, so you know that if price is now below the intrinsic value line, you are waiting for price to be a bit facing up and break if there is a downward flow, and break that flow, and you enter your buys without drawing lines, without observing anything. So I don't know if there was an indicator for intrinsic value, but I just draw it manually, so I'm not sure if there is an indicator for this. So but you should do your research. You should love researching stuff, guys. We should love researching stuff. So I hope it is making sense. How do you pull your take profit and stop loss using this strategy? You guys, you love calling strategies. So it's like when you call it strategy, then you guys become bound to it. I don't know, but the way I explain things, you can see that actually my trading, it is very, very broad. It is not fixed on one system, ne? Even if I can give you a method saying, for an example, this strategy that I made on YouTube, of saying, how do I erase, of saying we observe, it's a scalping strategy. You observe the moving average and then the stochastic. Now when price is above the stochastic, when price is above the moving average and then stochastic is over sold, we buy, ne? And when price is below the moving average and stochastic is oversold, we sell. So for an example, if I explain that, it doesn't mean that me, when I'm trading, I will only look at those things. It is because I'm just giving you a simple method. For an example, I can look at those things, at those two things, ne? And then also consider market strength, and maybe consider even sentiment, or even go further and consider maybe support and resistance, key levels. You see, it's diverse. It's remember the webinar that we had, that make sure that you have a lot of confirmational methods into your strategy. So for an example, even this thing of line of intrinsic value, it's not just like you use it only just as single as it is. You should add some other stuff. For an example, oscillators, maybe add volume, so that you can just improve a bit in the value of your signals or of your analysis, ne? So yes, you can call it a strategy, but know that you just need to involve a lot of things, guys. The information that you have is not useless. So if there is something that you learned about trading, you learned about fundamental, try to combine that stuff together, but let it not be something which is confusing, né? Let it not be confusing. So these are, you should try to just combine them so that they will work, guys, because once you focus on only one single thing, saying I observe price if it's above moving average and the stochastic is oversold or overbought, and then I enter my trades, you are going to suffer. I'm telling you, you are going to make profit, but you're not going to make a lot of profits than you were going to make when you added a bit of extra confirmation. Why are we lazy? So don't be lazy. Don't be lazy. The problem is that you like pressing buy and pressing sell without spending time in analysis. So don't be lazy. Don't be lazy. And I like the fact that even the guys who are on the private group, they have understand that it's not about quantity, it's not about how many trades we take, but it's about quality. If you take a trade and it's profitable, then you should hold it for days. If weeks, you should hold it for weeks. If it leads you to holding it for a month, you should be holding it for a month. So it's not about 18 trades or 25 trades that we open in a day. It's about the quality, and the quality is being produced from spending time in analysis, spending time in observing price, spending time in preparing for your entries, so you should know what's going on in the market. I hope that one is making sense. Don't think you are going to be successful by opening a lot of trades. Don't think that way. Just spend enough time analyzing. So when it comes to targets, let me just answer the question. When it comes to targets, like take profits or stop losses, it's an issue of observing the lows and the highs, which summarizes market strength. It's an issue of observing lows and highs. So for an example, I drew the line. Where is it? Let me just bring it back. I drew the line here, and in the middle of the price I drew the line. So when I buy after this market flow here, what is this tool one here? If I buy maybe after this break here, if I buy, it's simply obvious that my stop loss should be here, and my take profit, which is not known, take profit is not known. And this theory that I always teach about take profit, it is that we don't exit trades by take profits or by stop loss. I hope we all know that we don't exit trades by take profit and stop loss. We put those targets for emergency. So, and it also I was also just a bit disappointed on what happened on my gold trade. Let me just open, because we've been trading gold with the guys on the private group. So we were selling it. So when we sold it here, what happened is that we sold it here somewhere, when this flow was broken, somewhere around here, and our stop loss were obviously up there when we sold it. So this was the first observing point. This was the first observing point, meaning this is the first point where you kind of observe if market is going to reverse. So I think my take profit was somewhere around here, or maybe here. So what I figured out was that I found out that my take profit was meshed and I was out of the trade. So yet I was not ready to be out of the trade if I was to be observing by manually. It is because I was not there. I was not babysitting the trade. It happened that it meshed it and I was asleep, so I wasn't monitoring the trade. If I was awake, it was not going to hit my take profit, because my take profit is not stable. I always move it. When price come closer to it, I take it down. When price come closer to it, I take it down. So do you see the disadvantages of take profit? I was taken out here, and look, there is some kind of a lot of pips still going down. So maybe I was going to react after maybe some kind of market forming a structural going up. I was going to react and say I'm closing my trade. So that's the issue. That's the issue. You shouldn't depend on take profit. You should set it. Stop loss and take profit, it's a must. But then you should be there manually. You should be there manually, adjusting those levels depending on how the price behaves. Adjusting those levels depending on how the price behaves. So you see, if you are not are going to monitor your trade, for an example, you sell, you put your take profit here, you put your stop loss there, and then you go to sleep, or you go you never mind. Then price comes, it smashes your targets, and it takes you out. Yet you can see that strength is still favoring the sellers. There is still some market strength here. there's still some market strength coming in, ne? So it should be something that you do in terms of psychology, what you observe in terms of strength. When you observe shift in market strength, then you should be signing out of the market. Maybe if the market gives you some bit of higher highs or higher lows in a minor level like this, then you can close your trades manually. So stop loss is good, take profits can be a limitation sometimes. We are left with 2 minutes. So I hope this is making sense. We just need to take things a bit serious. Now we just need to take things a bit serious when it comes to trading. This is more like your job or your business. If you have decided to be a trader, so you don't just have to be playing like that. You don't have to be playing like that. You don't have to be losing money like that. It's money, even if it's $20, even if it's $10. You don't have to just play games like I'm going in and I'm buying gold with a very, very big lot size, yet you are having $10. What are you trying to do? You are trying to benefit from luck, which doesn't work. There is a quote in the book The Richest Man in Babylon. It says the god of good luck is found in a place where the doing of a man is worthwhile and worth of reward. So if you need luck, you have to be deserving it. You have to be deserving it by doing what? By putting the work, by being realistic. Then luck will come to you. It says luck is when opportunity meets with preparation, meaning when an opportunity comes and you are ready. That's luck. So even in the market, it's the same thing, guys. It's the same thing. You shouldn't be expecting to be lucky by, I was saying I'm putting $5 and I'm just going to be entering randomly. So in a very, very active trade like gold or Nasdaq or VIX 75. You should be realistic, saying, okay, I have $5. What can I do with that $5? Maybe let me go to V100 and open some few trades on V100, because V100 I know it is not going to wipe my entire $5. Or let me go to maybe USD card and open with a very, very small lot size and maybe a micro account. Be realistic and then put in the work, which is analyzing and applying that knowledge that we have. So we don't have time, guys. I appreciate you joining. Thank you. We are going to meet next time.